Okay, so last week, Jerome Powell was involved in his monetary policy testimony in Congress. And essentially, there were a bunch of senators that came to him and said, there's no reason for you to raise capital requirements for lending institutions. In other words, stop raising interest rates. Jerome Powell, being the G that he is, took it all in stride and said, forget you, we're raising interest rates. That was a week ago. And then over the past weekend, we had the announcement of two major banking institutions that collapsed. It was Silicon Valley Bank and Signature Bank. And if you don't know what happened with Silicon Valley Bank, I'm going to make this really brief and give you a brief synopsis of what happened. So, Silicon Valley Bank, the 16th largest bank in the country, really funds a lot of tech startups. That's really what they were known for. And so, because of that, they got a lot of deposits that came on hand. So much so that they did not have enough time to turn those deposits over into loans. They couldn't loan that money out fast enough. And because of that, they started to invest in US Treasury securities. But how does this all tie in with the Fed, and what does this mean? Here's what happened. When the Fed decided to raise interest rates, when they raised the security yield on that, or the interest rate, the price of those securities or bonds goes down. Now, here's how it affected Silicon Valley Bank. Let's suppose they bought bonds at a 1% yield or 1% interest rate, and the bond costs $1,000. Well, if that interest rate goes up to 6%, let's say, I'm just being hypothetical here, the price of those bonds has to go down to somewhere, I'm gonna call it like $600, $700. I'm not doing the math, but I'm trying to make this so that you understand what happened. Well, here's the deal. When this all happened, Silicon Valley Bank took a big gamble in investing in those securities, and they lost. And here's why. They had to come up with some liquidity at some point, right? So they sold those bonds at a loss. Consequently, it was almost a $2 billion loss. Well, when that announcement hit, there were a lot of depositors that ran and said, hey, give me my money. So they started pulling that money out of the bank. Well, if you've been following me for a while, and you should, I've told you that when you deposit your money into a bank, it doesn't sit at the bank. The bank loans it out, car loans, mortgages, credit cards. Sometimes they loan it back to us at a much higher yield, but that's a whole different story. So they didn't have enough money on hand to account for all the depositors that were coming in and taking out their money. And because of the withdrawals that happened and the big financial hit that they took, regulators stepped in and said, hey, we gotta shut you down because we gotta protect the depositors. Well, here's the deal. Side note, when you deposit money in the bank, you normally see that sign that says FDIC insured. Now, FDIC was instituted back in the 1930s, actually 1933 to be exact, and it was really spurned on by the Great Depression when bank failures and all these things happened. So FDIC was instituted by Roosevelt to basically ensure that anybody who had money in the bank would get their money back if a bank failed. Now, the sum at that time was like $2,500. Obviously, that doesn't do anything for us right now. Now that sum is $250,000. So if you have money at a bank that's $250,000 or less, you are FDIC insured. If you have money over that, good luck. Now, Silicon Valley Bank, I told you, did a lot of tech startups and venture capital firms. So 90% of its depositors had deposits over $250,000, which meant that they weren't protected. Now the market starts to go into a panic. And we go back to that congressional testimony with Jerome Powell, and the senators are going, I told you, stop raising interest rates, because this is going to have a deep impact on the economy, financial markets, and just on the everyday consumer. But these are kind of one-off deals. So Silicon Valley Bank and Signature Bank both dealt with a lot of like tech and crypto. So we don't expect this to happen within the banking industry overall, but still it caused a stir in the market, a panic. And anytime there's panic in the market, yields or interest rates go down. So over the past week, we've seen interest rates tick downward. Now, the Fed is supposed to meet again on the 22nd. And they're going to be looking at inflation. They're going to be looking at unemployment. They're going to be looking at this consumer price index. They're looking at all these things. And of course, inflation. So now the Fed has some decisions to make. Do we not raise the interest rate? Or maybe we don't raise it as high as we would have liked to get this thing called inflation under control. And this is where you, as the consumer, either buying or selling a home, or even as an investor, you need to be aware of what's happening right now, because it's definitely going to have an impact on your pocket, on your financial home, all of that stuff. So you just want to pay attention to what it is that they're saying next week, so that you can make informed decisions on what to do next. If you're looking at buying or selling a home, this might be the right time, right? Because interest rates are downward ticking. But depending on what the Fed announces next week, could see interest rates go back up, because everybody knows in this market, things change at the speed of light. Who thought we were going to see 2 massive bank failures in a span of 48 hours? That's just 2. There was another one, but I won't get into that. Just so you know, again, this may be the time for you to make a move, but you got to make it using the data, using very informed decision making, and seeing what's coming forth from the Fed, from the banking institutions, and keeping an eye on all of this stuff. Now, there's talks that we could be spiraling toward a recession. We've been talking about that for the last couple of years. And if we are, because one of the things the Fed talked about, or one of the things they accused the Fed of talking about on Capitol Hill, was that the Fed was trying to break something. And quiet as kept, I've been telling you, the Fed is trying to cause the unemployment rate to tick up. And that's one of the questions that Jerome Powell got hammered on, is why would you do that? And it's going to affect all these homes. Well, the issue is kind of, do we do this and affect 2 million people, or do we not do this and affect 2 billion people, right? So the question is kind of, you take the loss for the greater good. I don't necessarily like to look at it that way. And Jerome Powell's not going to say that, but quiet as kept, that's really what he's saying. That's really what the Fed is saying, is, look, we might have to sacrifice that 2 million for the greater good of the rest of the country. It sucks to hear that, but that's just how our economy works. They only have a couple of levers to pull to control inflation. Raising the Fed funds rate is one of those things. And because when they do that, the cost of borrowing increases. It not only increases for you and for me, it increases for companies. So when companies are like, we need X amount of dollars to continue to manufacture these products, that cost gets directly put onto them if they're borrowing or leveraging in order to create those products. Now, if they're borrowing at a higher cost, they got to pass that cost on to who? The consumer. But we're already dealing with inflation. So how do you raise prices on consumers who are already dealing with high prices? Now you got a decision to make. Hence, one of the things that they do is look at overhead. And one of the big overhead expenses for many companies, you guessed it, employment. So we are probably going to see some layoffs. We'll probably see the unemployment rate tick up over the next several months, which again, on the low, is something that I think the Fed is trying to cause. That's going to have some other effects on the economy. I won't get into all of that right now, but just going back to this example of the bank failures, there's no need for you to panic right now. The banking institution, as far as we can tell, nobody's 100% certain, is we're okay. These are kind of 2 one-offs, I guess you can say, with banks that specialize with a particular type of clientele, being tech startups and venture capitalist firms. But when you got other banks that don't really deal with that kind of stuff, you may not have to worry about it, because let's face it, most of us don't have $250,000 sitting in one account in one bank. Most of us probably won't see $250,000 saved up over a lifetime, but we can get there. So I won't even go there. But again, just be prepared if we do get ready to hit a recession, that there's some steps that you can take. And if you want to know what those steps are, I want you to watch this video coming up right here.